Joining us now here on set, David Zervos, Jefferies chief market strategist, a CNBC contributor. It's great to have you here. Welcome.
It's good to be here, Morgan.
I mean, it's worth noting that they're also flying blind without not a whole lot of data right now, given the government shutdown. The quantitative tightening piece of this, I want to get your thoughts on that.
Yeah, I mean, a lot of people would say just on your flying blind that the Fed does fly blind a lot. I mean, we've had massive revisions to these labor market data over the last 18 months, so it's not at all clear that it's that different. But I hear what you're saying. I think on the QT, look, very much to me expected, given what we've seen in money markets, repo, SOFR's been a little quirky. Mm-hmm. They don't want to take chances with that. Reinvesting straight into T-bills, all the mortgage stuff, kind of seems to fit the Waller mantra and some of the mantra on the committee that they don't want the duration to extend too much on the portfolio side or on the holding side. I don't think it's a big surprise. I don't think anything in here was a big surprise other than Powell came out like really wanting to be hawkish. I just felt like from the start, it was like, we are not on a preset path. We are, we have strongly disagree. The committee's got strong disagreements. It just felt like he really wanted to make a statement that we shouldn't take December or anything in the future that seriously. And I feel like the market kind of yawned. It was sort of like, okay, you're hawkish, but you're gone in May. So maybe it's not that important. And I feel like that's the summary of what I saw today.
Okay. So how does that set us up for December and perhaps more importantly for 2026 now?
I think that's where the market's focused. The market's focused on the fact that this committee is going to do a lot of changing. It could go in a lot of different directions in the next 6 to 9 months. It's going to be, I call it a more cooperative committee. Some people call it a more dovish committee. Some people might call it other things. But I think it's going to be less of a headwind, more of a tailwind, probably take a little bit more risk with inflation and focus a little bit more on some of the jobs data that look somewhat unpleasant when you dig a little deeper. You guys, at the micro level, what are you reporting on every day? It's this layoff, that layoff, these changes. The AI guys that I speak to, and you speak to them much more than I do. I mean, they're pretty dystopian, some of them.
Oh, yeah.
Like really dystopian.
Privately.
But happily so.
Well, yeah, because they own the capital.
Right, exactly.
So
you're saying enough of the uncertainty talk, enough of the bubble talk, but there have to be a couple of things that you're tracking that could be concerns. What are they?
So, look, we're always going to, when we're looking at central banks, we're always going to worry about that inflation, right? The inflation is the kryptonite. Great CPI data by at least expectation standards, but you're still watching it, and it's not out of the woods by any means. But I just think they'll be willing to take more risks as the committee evolves in 26 and 27. And I think there's a lot of that AI story that you cover every day, which just has a lot of disinflationary 90s style overtones to it. So I feel pretty comfortable that that's not the big risk. The big risk is that we wake up in a year or 2 years and we have a pretty strong economy with not much inflation risk, but the unemployment rate's got a 5 handle on it. And we're wondering, how do we get these jobs, like really good quality, generally what we would call good quality jobs, kind of how do we get people back into this labor market?
But cutting interest rates can't be the only prescription for fixing that, can it? What else needs to be done that the president isn't already doing?
Well, I think there are a lot of things they could do. There's lots of ways fiscal policy can address that, but they're long-term, right? They're sort of training programs. They're redirecting some of the things in the One Big Beautiful Bill, put vocational schools back in focus and giving funding to vocational schools, recognizing that those trades had been largely left behind, maybe focusing a little less on some of the service sector stuff. But, I think monetary policy can affect labor demand. I mean, you saw the reaction in home builders today wasn't great, right? Mm-hmm. Like, we need people to build homes. We need more homes. If we get interest rates down and mortgage rates have a 4 handle or possibly even a 3 handle in the next couple of years, that's a place where we could see mortgage banking, we could see construction, we could see anything related to real estate services and real estate in general, kind of maybe offsetting some of that AI dystopia that we hear about every day from many folks in those companies.
In the meantime, if we do take a look at the markets, I mean, we are trading right near record highs. Risk on, does that continue?
I think so. I think it's a fantastic investment environment. One of the best ones I've seen. The micro I talked to our bankers at Jefferies, and it's just like they're as busy as they were in 2021 when I thought they couldn't be any busier. I think, they schedule 10-minute meetings sometimes. When the meeting sizes get really small, it's like, I got 10-minute windows for you. So I think that's a great sign that the dereg story that I've been pushing most of this year, the less federal government, the sort of get out of the way, let business do what it does, get the government out of the crosshairs of every transaction. Just let us do what we do best, maybe sometimes too good, and get a little crazy. But those are in the end games. And just you're seeing it at that micro level. You're seeing, I think, the dereg story really drive. It's just M&A. It's investment. It's a lot of capital returns and a lot of earnings potential that get me very excited about that risk on trade. And if something goes wrong, I think we got a lot of room for the central bank to kind of come in and buffet that. So I feel pretty good about my risk parity trade. It's been a great year for that. Probably going to stick with it in 26. And I think you got to have double-digit returns on the equity side, and you could have some pretty good returns on the fixed income side if this committee kind of becomes a little bit more cooperative.